Okay, this video goes with the blog I just wrote about ETFs and the three differences between today and 2008. And quickly, remember the big difference between an ETF and an index, and we'll also say a mutual fund because the mechanics of how they're traded are the same. Right, index is unmanaged. A mutual fund, a manager is buying and selling all day long, right? But if at the opening bell at 9:30 Eastern, let's say, China does something incredibly crazy and the market just is cratering and you think, you know what, this is it. And you pick up the phone at 9:40 and you say, sell, get me out. They'll put the order in, whether it's your broker or you're calling the 1-800 number for whoever mutual fund complex or even index complex you're using. They'll put that order in right away. But guess what? This order is not going to be filled until after the closing bell. So if there is a true downslide, and we know this happened in a way when you get these big double-digit moves just in one day, this is painful. So investors and Wall Street recognize that they need more flexibility, and that's where the ETF was created, right? ETF stands for Exchange Traded Fund. So, meaning you can buy, sell all you want to all day long. And when you're able to have that kind of ability to go in and out, it creates a very important dynamic, and that important dynamic is liquidity. Now, liquidity is always a good thing. You want to be able to exercise your investment strategies, but there's times where liquidity can be a challenge for a money manager, in that when a large institution, a large trader, or a herd of investors all do the same thing because they have liquidity, that can be difficult for a money manager to navigate. So ETFs have become incredibly popular since they were first launched in the 90s, and now there are over 5,000 of them. And I was doing a class recently where I showed all the different types of ETFs. You can have an ETF by sector, and this is just showing a few of them. So for instance, you could invest in the banking sector, the retail sector, the healthcare sector, etc. You can also break the ETF down by region, not only continent or country, but as you can see here, you can even do states. You can see California's on here. And you can break up a subgroup, as you can see, developing country, so developed Europe versus emerging Europe, so smaller nascent companies versus established companies. You can invest in different commodities with ETFs, gold and silver being the most popular because not everybody wants to actually own the coins, and they don't want to own the stock of precious metal companies, so they can get an ETF in a particular commodity. Here are some of the issuers of ETFs, and you can see that it's the biggest of the biggest investment banks and money management platforms. But the main slide I wanted to show you is this one here. You can invest in an ETF by style. So you can look at dividend stocks, you can look at large cap stocks, mid cap. You can see how the S&P 500 is broken down. But the one I want you to focus on is volatility, because that's really the core of today's conversation. And that is that the most crowded trade in 2017 was on the VIX, the volatility of the market, the ups and downs. And so this liquidity event that I was talking about earlier occurred in this particular sector. And it happened right here on this February 1st, earlier this year. This is the Dow Jones Industrial Average. This is that famous Friday where the Dow went down 666 points, right here in this section right here. From right here to here in that day. Then here's a headline. Dow's dropped 666 points, ominous signal for stock market. Now, that was just the one day. Look what happened the next trading day. Right here on Monday, it really cratered down. And then we had a little bit of a bounce, and then it went down even deeper. So this was a big move over this period of time, this 2-week period of time, the market was down significantly, and this caused a lot of jitters. But these 2-day period right here, this was an event that sent a ripple through Wall Street because it caught a lot of money managers off guard, and it was a liquidity event. So money was taken out of the market very quickly. And I think we're eventually one day going to find out, because there's an SEC investigation going on, and there are also some class action lawsuits because some managers failed, and it was really ugly. So before I walk you through the mechanics, let's look at the issuer, Credit Suisse. Credit Suisse is a top 30 bank. As you can see the headline here, Credit Suisse fund liquidated, ETFs halted as short vol, and vol stands for volatility, bets die. So this is what I was talking about. In 2017, the most crowded trade was volatility. And so all the short volatility bets got creamed. So let me explain how this works. So let's first understand what the bet was, right? What the hedge was. The VIX, the volatility, with Trump coming in, everybody anticipated that his grow, build would work, and that the economy would just do this slow grind upward, which is a positive thing. You want that because it's measurable. So here I'll show you the VIX. You can see it's right here, VIX. So this is over the last year. And for the VIX to be bouncing around in the 9 to 12 range is pretty stable and predictable. So look at last year in 2017, right? Very little movement, very flat. So that's why you understand it being the most crowded trade. Everybody was expecting low volatility. And then this event happened, this spike up to almost 40, and look how sharp it was, and all happened in a very concentrated period of time. So Credit Suisse had 6 ETFs. Now, the thing about an ETF, in its policy statement, it has to have what's called a terminal point. And a terminal point is where the outside custodian, the investment bank, so here's your ETF, right? And it has all of its different holdings inside here. Well, outside of here is a custodian, an investment bank, and they have a terminal point assigned. Now, look, these Credit Suisse people are very smart. And I'm sure when they were designing these ETFs, because they were required, they assigned a very low terminal point. I'm sure they're sitting around a table and one of them said, you know what, let's just make the terminal point 80%. You know what, it'll never go down 80%. Well, I just showed you in that 2-day period of time, it certainly did, right? So the ETF, that hedge that they had did go down. The investment bank calls and says, terminal point, you're done. You're shut down. So everybody that had money in this ETF lost big. And these are big players here. Let me just show you some of the people that were in there. So these top 2, Jane Street and Susquehanna, say that 3 times fast. You can see that they lost 27 million and 17 million. Now these are 2 really big trading platforms. Societe Generale is a top 10 insurance company. You can see Credit Suisse, obviously they lost money because it was their funds. But look at a few of these other, McKinsey Financial. Now, this is one of the top consulting groups on the planet. Morgan Stanley. And then look at this, Harvard Management. Everybody always talks about the Harvard and Yale endowments and how well they perform. And look, even these wizards of wonder in these Ivy League schools, Harvard lost $1.5 million. So like I said, not only are these smart people, but the money managers in general look at this event and they really don't know what to do about it. So this is why you're not seeing a bunch of coverage by the media, you know, the CNBCs of the world and the Fox Business and so forth, even the Wall Street Journal. You're not seeing a lot of stuff written about this because they don't know what to do about it. And that's why I want to do this blog about the 3 differences between today and 2008. So quickly, the first is that our Fed, they're over leveraged, right? They have way too big of a balance sheet and they cannot bail us out like they did in 2008. Not that we would want to. I think the 2008 bailout was a total scam, but that's another story. The second is that interest rates today are much, much lower than they were in 2008. So if there's a massive correction on the scale of 2008, you're not going to have anywhere to run on the bond side. You might make a little bit of money, but you won't get the pull through that you got in 2008. And then the third big difference is this preponderance of ETFs. These 5,000 ETFs that have created all this massive liquidity. And again, liquidity is a good thing, but in this context, this shock that we saw, when stuff like this starts to happen, you know what? It can cause some dramatic complexities that people are not prepared for. I don't know ultimately what's going to happen. I don't know the solution they're going to come up with. I know what we're doing on our investment platform, and I'll give you a hint. It's called forward-looking due diligence, and I'll actually do a completely different video on that. But just to reiterate, I'm not trying to be a Debbie Downer. I think this is happening. I think what Trump is doing is brilliant. I think the economy is growing, low unemployment. Now, as this economy grinds up, the Fed is going to continue to raise interest rates, right? So they're going to raise interest rates, which is going to affect the stock market, right? Because, you know, that just happens in these rising interest rate environments. But this overall trend right here is a complete positive. But we can't be naive, because this issue here, this can happen besides things that go on in our economy. Just look what's happened in the last 2 weeks over in Europe, specifically with Italy and even Spain and the banks, right? That kind of contagion could cause a lot of things to ripple through our economy, our corporate balance sheets. But anyway, hopefully this was helpful to you understand a little bit more about ETFs, but also about this new dynamic that has come about because of our desire to build liquidity. Okay? Thanks for watching.